Rahel,
Richard.
I look at our delightful Christmas tree and I see markets, recession, higher interest rates, all the things that you have been talking to us about over the course of the year. What's been going on?
It has been an eventful year, right? I mean, if you think about where we're coming from, it was just March, not even a full year ago, where the Fed started to raise interest rates, and they have done so much in a short period of time. Now we're sort of in a wait and see. Not yet, but soon. Keep them higher for longer, and let's just see how this plays out. And I think the big question heading into 2023 is how much pain, how much damage will the Fed potentially have caused?
When I heard Chair Powell in the December meeting talking about 425 basis points of interest rate hike, 4.25%, and you look at the graph and you see, I mean, it's not even, it's not, it's straight up. It is an economic conundrum that the economy hasn't just gone into full-scale recession and reverse. That's people don't understand.
It has been a dizzying pace, right? I mean, because when you look at previous rate hike cycles, you see it's sort of a gradual 25 basis points. This was not that. And so I think the question, as Powell has pointed to, there is no painless way to do this. So I think the question is, how much pain will that sort of dizzying pace of rate hikes ultimately cause? And I think that's a big question next year.
Why hasn't the economy slowed faster?
There's so much happening right now that is a result of the pandemic. Think about how strong the labor market is, right? I mean, think about how much excess savings people have because of a few things. Stimulus packages, not just one, but two that really infuse a lot of cash into the market. And then two, people were sitting home for about a year with nowhere to spend their money, right? I mean, how many decorative pillows can you buy? And so people have this buffer that's sort of been powering consumer spending, but we're starting to see that change.
Right, but because the point is you've had this fast increase of interest rates because of these other factors. As these other factors start to abate, you're left with just high interest rates.
Yeah, exactly. And it's interesting because I think at this point in the inflation cycle, you're no longer seeing goods inflation, right? You're no longer seeing supply side inflation. You're starting to see a lot of wage inflation. You're starting to see a lot of service side inflation. And so now the question is, well, how much damage does the Fed cause to the demand side of the equation? I think investors heading into the December meeting were hoping finally for some dovish language, finally hoping to hear Powell say, all right, we're going to take a wait and see approach. And they didn't get it, right? And so I think even heading into 2023, it will still sort of be investors holding their breath, waiting to finally hear those words from Jay Powell.
What are you looking forward to next year?
I am looking forward to a return to cooler inflation.
No.
Personally or professionally?
Yes.
I mean, personally too. I mean, look, I am a consumer as well. I mean,
you don't have time to consume. We keep you too busy.
I would like to be paying less rent in New York City. I would like to be paying a lot less for practically everything. So personally and professionally, I am looking forward to less inflation. And I am also looking forward to sitting in your chair while you're on vacation, because that's been a great part of 2022 for me.
Well, as anybody knows, I don't take vacation very often, so I look forward to
Hold my breath.
Thank you very much.
Yeah.